this formula here with present valuing, you can simplify that into a formula like this. If you can figure out the expected future earnings in the investment, think about that bond, okay? And you can figure out the rate of return on that investment, you can figure out its value, right? A bond yield, with an interest payment of $1,000, that's 10% rate of return, you can figure out what the value of the bond is. For a business, it really comes down to cash flow. And we'll talk about the definition of cash flow. But the business value is going to be driven by what we think that predictable cash flow looks like. And how much is it in dollars? Do I think it's going to grow? Do I think it's going to be really variable? If it trades in a wide range historically based on historic patterns, why should I assume differently? That would represent a higher risk to me, right? So the capitalization rate or the discount rate then is the risk associated with it. So these two things are kind of, for a particular company, you can't kind of separate the two because they're so related. Your expected cash flow is going to be a number, which is more predictable or less predictable, and then a whole lot of other factors play into how much risk is associated with it. To Phyllis's point, if the management staff is weak, if the cash flows are really vary, if I look back at my cash flows and they're very narrow over periods of time in terms of the variability of them, versus if they're really widespread, I'm probably going to be more careful about what I'd be willing to pay. Okay? So this takes that formula of discounted cash flows and a discount rate and having to project out. This is a very simplified way of looking at it, that many transactions are done based on something like this. This is overly simplified, but this is the basic theory of an investment value. It's whatever the future cash flows are divided by a rate that reflects the risk of the cash flow. Okay?